All right. Hey there, everybody. Good morning, good afternoon, good evening, depending on where you guys are at. I hope y'all are having a good Monday and had a safe and wonderful weekend. Thank you so much. Appreciate that, Simpler. So, as always, we'll get started here with SPX. And usually, whenever we do these sessions over at the Simpler website in the options room or in the small account mentorship, it is like a total request live session. So it's usually whatever symbols that you guys want to look at. You can just call me Carson Daly, right? I'll pull them up. We'll take a look, see if there's anything viable. I'll give you my 2 cents on the chart. And if it looks good for a actual trade setup, then we'll walk through a few different trade ideas to consider taking on the charts together. So I'll let you guys load up in the chat here. If there's anything you want to look at, let me know. Otherwise, if nobody has any symbols that they really want to look through, I'm happy to go through some of the ones that I'm curious about how they're trading today. And of course, we can always pull up some scans and take a look at it that way. So let me do one more thing here and then we will get going. I'll wait for a second, see if anything pops up in the chat. And we'll get started. Let's first start here with SPX. So starting from an intraday perspective, unfortunately, I wasn't able to get the levels out in time, but I'm happy to talk about them here on the mic. So for my intraday traders, I did go through this morning and mark down some levels I'd be mindful of. Starting with support, certainly for those of you who kind of already know how I like to trade, then y'all know once we start to break above 44.50 as a psychological level, right? We had a little bit of a dip this morning, attempted to break below it, but really couldn't get past 44.45. 44.40 has been a short-term price support level to be mindful of. So we basically opened a little bit lower, held on to 44.40, and then bounced back up. And once we start to break 44.50, you can see here on the 10-minute chart, for example, whenever we pulled back, we tested that range and did a good job of holding it as support. That was a sign that we could likely bounce off of that, at least into the next intraday resistance level, if not higher. And let me just pull over my note this morning. This is what I usually, when I get a chance, try and send out to the small account mentorship chat. And you'll see that the next range that I talked about to the upside whenever we were trading around 44.50 earlier this morning was 44.59 to 44.65. And that's because we have multiple intraday resistance levels there. You can see that we had some of those levels down here. On the 5-minute chart, we have the ATR trailing stop in that range currently on the 10-minute chart. So that's kind of where we're stalling at right now. On the hourly chart, when we zoom back in, if we are able to break above this level, the next range is up to 44.73 to 44.80. Not too far away, of course. And that shouldn't be too surprising because when we take a step back on the hourly time frame, we know that we've been in relative chop, and this will definitely be clear whenever we pull up the daily chart as well, that we've been stuck in this consolidation overall. So those would be my next targets to the upside. You can see there's a 100-period simple there on the 10-minute chart to be mindful of. We have the 30-period simple on the hourly chart at 44.73. And then just below 44.80 currently is that 100-period simple. So all of those ranges could act as resistance if we can manage to break above this current level of resistance that we're at. If not, and we start to pull back, then I wouldn't be too surprised, of course, to go back down and test these support levels or even back down to the 44.50 range. And overall, we might start to find ourselves in some chop, right? So let's pull up the daily chart and kind of talk about why that is. So here's the daily chart. Now, there are a few different reasons, both from a technical perspective as well as a news perspective, on why we might still be in this choppy range. From a technical perspective, we have our Bollinger Bands, which are completely flat, or in the case of the lower Bollinger Band, right, it's coming up to meet the price, so it's converging. So that overall is a sign of consolidation. Our moving averages are technically in a bullish trend. The short dashed line, for those of you who don't know, is my 10-period simple. The longer dashed line is my 30-period simple moving average. And the solid gold yellow line is my 100-period simple moving average. So technically, when it's the smallest decrement to the largest, we're in a stacked up bullish formation. But you can see that the 10 and the 30 are basically converged, right? They've flattened out with the Bollinger Bands, and that's currently where the underlying price has been hanging out for the past week and a half. So that's part of the reason we're in this consolidation. When we take a look at our lower indicators, they match up with that perspective. We have our awesome oscillator here, the bars. You can barely see as we zoom in. They've kind of been hugging both on top and below this red horizontal zero line. So that's an overall sign of consolidation. We have a choppy signal here on the compound breakout tool. It's not giving us a solid bullish signal or a solid bearish pullback signal, right? It's just flipping on and off. So usually when you see it look like that, that is a sign of chop. You can see here, for example, whenever it printed back to back for a little bit, it was a sign of consolidation there. And then it looks like we're attempting to form a daily squeeze. That's what that purple dot down here is telling us. And usually it's not uncommon for a squeeze to start to set up during consolidation, which potentially could also mean that once we get out of this consolidation, if that squeeze remains valid, could see a bigger than anticipated move, right? We could get maybe a little bit of a run going, especially if that squeeze really builds up some energy to it. So from a technical perspective, right, it makes sense for the consolidation. Another reason why from a technical perspective really quickly is because on the weekly chart, we know that we've been resetting off of bullish exhaustion. We had this beautiful run that happened back here in March of last year, just a solid, nice run to the upside, which was great to see. You had bullish signals with momentum telling you that, with the compound breakout tool, with the squeeze. You had a recent true low. So all of that kind of helped that bullish perspective. But when the momentum bars get to the top of the axis, that's usually a good sign that you're at exhaustion, right? And so what that means is whenever the bars start to pull back towards the zero line to try and reset that momentum that occurred to the upside, the underlying price will typically do one of two things in the case of bullish exhaustion. It will either pull back with the price, right? And so you'll see it drop back down, or it will consolidate. And that's what a lot of traders end up forgetting about, I feel like, is you don't necessarily need the price to get a strong pullback in order for momentum to reset. Sometimes all that occurs is consolidation, right? It's like taking a marathon. You ran the miles that you needed to. You're at like a little pit stop for a break, right? You're grabbing some water. And it's not like you're running backwards, right? In the marathon, you just rest for a second. And so that's kind of what the underlying price is doing. It's resting right now, allowing the momentum to reset so it can build that energy potentially for the next run higher. Or if we do start to roll over, maybe a little bit of a bearish pullback move. Now, the question about which way we will go could depend on what's happening on Wednesday. And that's part of the reason why we might see a bit of chop, at least early in the week, going into Wednesday's announcement. And for those of you who don't know, on Wednesday, it is an FOMC meeting, right? We have Powell talking. We have the possibility of a rate hike. Last I saw on the Fed future side of things, and this might have changed because this was last week when I looked at it. But last week when I looked at it, I think it was about priced in around 97% of the Fed futures were pricing in that there would be no rate hike, that it would be a pause. And only about 3% at the time were pricing in a potential rate hike. So that, of course, could dictate what the market does. Now, I will point out last year, of course, off Fed announcements like this, off just Powell or one of the other Feds opening their mouth, off CPI data, right? We saw a lot of volatility. Those were sometimes the most volatile days that we had in last year's market. This year, they've been a bit more of a non-event, right? We haven't seen certainly the follow through on weekly volatility. And what I mean by that is we might get a little volatility the day of, like if I remember correctly, right around there was like the Jackson Hole meeting where, they didn't do anything, but they talked right on the mic, and that caused a little bit of intraday volatility. But the volatility doesn't last, right? For example, here, this day was off CPI, and you can see that was almost a 200-point range off of CPI last year. And the move, the announcement itself, right, caused stronger follow through days and an overall bounce and directional move to the upside. Whereas this year, it's been more of a non-event, right? Sometimes we've just remained in chop for the rest of the week before it maybe gets a little bit more of that directional move going. And so because of that, we might get some intraday volatility, certainly the day of the announcement. It usually occurs at 1 p.m. Central, for those of you who don't know. What typically happens, for those of you who need a refresher or maybe newer to trading, so you don't know how Fed meetings work, what typically happens on a Fed news day is we usually see a bit of movement in the morning, but we start to identify a range usually early on. Now, this doesn't happen every Fed day, but it's more common than not, to why I'm presenting it to you guys here. So usually in a normal day of trading, you get volatility and then you start to consolidate during the lunch hour, right? And then you pick up on volatility going into the close, some sort of range ideally. On Fed news days, you usually get a little bit of movement in the morning, but you get that range of consolidation earlier in the day, right? Maybe right after Europe's close, or sometimes even earlier than that, well before typically the lunch hour occurs. And that consolidation typically lasts until the initial Fed announcement is released, which is at 1. And then what happens is you'll typically get a bit of a spike in volatility, oftentimes in both directions, both up and down. And then it might take a little bit of a pause again, depending on what the initial announcement is. For example, if there's not going to be any sort of rate hike and that 97% that are pricing that in are correct, then it might just kind of stay flat and hang out after the initial, pop or sell that occurs. If we do end up getting a rate hike, right, which is not what many people are anticipating at this point, then that volatility might last a little bit longer. But either way, usually going into 1:30 is when Powell will jump on the mic and actually not only present a little speech, but then he'll answer questions. And during that time, that's when the volatility respikes. And once again, not uncommon for it to happen in both ways, both up and down. But typically, once the questions get going and he starts to answer them, the market usually chooses a direction to move. Now, last year, that direction was usually a very volatile move and a directional move. So either the market would go up strongly into the close, or it would go down strongly into the close. This year, because we are attempting to get back into that more bullish trend market, from looking at the technicals, sometimes what happens is you'll get the spike of volatility around the news, you'll get the spike of volatility in both directions around around answering the questions and the press interview. And then sometimes it actually flattens back out, not uncommon, within the same range that it was in earlier in the day before the announcement, right? Because it's basically a non-event. The market has already priced in the anticipation, for example, of no rate hike. And so then it kind of goes back into that range, hangs out, and that's what could lead to it chopping more later in the week rather than getting a directional move. So keep that in mind for Wednesday, of course. Be aware that that's how the market typically works, and that it is not uncommon going into Wednesday earlier in the week to kind of just hang out, right? And that's what we've been doing really since last week. Even last week, CPI back here was not really much of a market mover, right? Compared to what we saw last year. This year, our last CPI day was a $25.87 range versus our last CPI of last year was just shy of a 200-point range, right? Big difference. I will point out here really quickly on the daily chart, we're, like I said, doing a really good job of basically holding that 44.50 range as support. We're attempting a bullish divergent bar into the close. So that, of course, if it does print, for those of you who aren't familiar with this indicator, means that we could follow through with a higher high within the next 3 bars. Usually it likes to occur within the next day. You can see that happened here. You can see that happened here as well as back here, and then back here off that bullish divergent bar. So that's certainly a possibility. But even if that were to occur, I don't know if I'd anticipate necessarily a strong move above 4,500. And keep in mind, if the market sells off into the close, this signal might not be valid. But if it does remain valid into the close, and you guys wanted to consider a trade to put on here, one possibility, and you have to decide how you want to do this. Usually for the divergent bar, I like to give it about a 3-bar rule, meaning usually for that higher high, I look for it to occur within 3 bars. That is what I have found to be the sweet spot. And so if you want to be strict on the technical rules around this indicator, you would go out at least 3 trading days. In this case, I'd probably go out to Friday, right? Why not give it the whole week? And then I would go and look for some sort of bullish trade idea, whether it's more of a vertical spread, right? Just a simple vertical spread to play up into 4,500, or maybe a debit broken wing butterfly. And I would stick with a debit broken wing butterfly over a traditional standard butterfly in this case, because if you're going out to something like Friday, one, the reason why I prefer this over the standard is even though the standard's a lot cheaper, the debit broken wing, if this move gets the follow through tomorrow and immediately happens, the debit broken wing typically allows for that better profit potential more quickly because of the difference of spread width. So because you have 10 points on the debit spread side of the trade versus 5 points on the credit spread, if it gets that bounce to the upside and tests 4,500 tomorrow, this will allow for a much bigger profit compared to the standard butterfly. And that's because the theta on the credit spread isn't necessarily helping offset yet the intrinsic value on the debit spread because they're the same spread width. So because you still have 4 days of time, and more importantly, because this is technically an expiration after the Fed news, if we get that strong pop tomorrow to test that range, this will likely be trying to hold on to a lot of its value due to the uncertainty around Wednesday. So you have a little bit more flexibility if the move happens quickly in your favor with the debit broken wing butterfly because of that debit spread being a wider spread width in general. And then the second reason why I would do this is, let's say it does take 3 days to follow through. Let's say it's the Fed announcement itself that's a catalyst for a bounce up and a run higher. Well, if all of a sudden you start to find that this spread is going in the money because the market's going up here to test the ATR trailing stop or trying to get a run higher into 4,600 again, then the debit broken wing butterfly gives you a bit of forgiveness factor if it goes completely in the money. If this, for example, let's say we paid, to keep the math simple, let's say we paid $2 for this trade. Well, it has an $8 profit potential if it's at 4,500 on Friday's close. But let's say we're at 4,600 at Friday's close. Well, then the debit broken wing still allows for a $3 profit potential. And once again, that's because of the difference of spread width. So you take the debit spread of 10, you minus it from 5, you're left with 5 overall. And that 5 is what the trade would cash settle for example, right? It'd be worth $5 if all these strikes are in the money going into Friday's expiration. And then 5, of course, minus our $2 cost basis would still be a $3 profit potential, still over 100% return on our risk, right? So not a bad risk versus reward scenario, whether it's the max profit or whether it goes completely in the money. So that's part of the reason I would hang on to this as a debit broken wing, or just a straight vertical spread versus maybe a standard butterfly. If a standard butterfly goes completely in the money, then unfortunately the two spreads already offset each other, so you lose the debit that you paid. Now, that being said, you could also look to do this for tomorrow's expiration. Now, that's a little bit riskier, right? Because it doesn't allow for the 3 full days to try and get the higher high. But as you can see here, a lot of the times that higher move does occur within the next day, right? That higher high that follows through. So if that's what you're really anticipating, if you still think it getting up towards 4,500 is a possibility, then you might go out to tomorrow's expiration, which won't have the same kind of effect with theta decay, and you could look at a wider width spread first of all, right? If you want to keep within a $2 risk, you could certainly look at a 10-point spread over a 5-point vertical spread. Or you could, of course, consider maybe a wider standard butterfly, right? Because it's tomorrow's expiration versus Friday. And the benefit of doing something like that is because if this does print and get the follow through, by having it with tomorrow's expiration, you don't necessarily have to worry about the extrinsic value building up into the Fed announcement. And what I mean by that is usually on the options themselves, if it is Wednesday's expiration or after, it's kind of treated like an earnings announcement, right? Where there's uncertainty about which way the market could move. So what happens is the market makers like to build in value onto these options, right? They want us on the retail side to pay more. It's annoying, but that's just the fact of life. And so it keeps the trade ideally a little bit cheaper. But at the same time, it means that if we get the immediate move, the extrinsic value on the credit spread side of the butterfly should still work normally compared to if we had it on a Wednesday expiration or after. If we left it out for Wednesday or after, because of the uncertainty about how the market could move around the Fed, it's going to keep that premium tied up until that announcement happens at 1 o'clock. And then at 1 o'clock, that's when you start to get that theta decay to start kicking in again. And certainly after 1:30, once there's a little bit more of an idea of how the market's reacting to this announcement, that's when the theta, especially on Wednesday's expiration, but even on Thursday and Friday, that's when that theta decay starts to erase itself from the premium that was built in going into the announcement. So if you want to try to avoid, that buildup in premium and the theta not really offsetting your trade, then you might consider tomorrow's expiration instead and look at a different trade idea like this. Just, of course, be mindful of your risk always, right? No matter what trade you get into. And also understand that with the 3-bar rule, it may not follow through tomorrow. So really keep your risk, I would say, on the smaller side if you're doing tomorrow's expiration versus maybe going out to Friday where you have a little bit more flexibility on time and you're giving it the proper 3 days to try and get the follow through. So that's what I'm seeing on SPX. That's a trade idea if, of course, that signal prints into the close. And for those of you who prefer the theta decay route, you could also consider a put credit spread or a put unbalanced butterfly with the idea that we're not really going to strongly break this price level. That way, if let's say we barely follow through with the higher high, kind of like what we saw here and it chops, your credit spread could still benefit you as long as your short strike is out of the money. So I don't see anything coming in through the list of what you guys want to look at. I know some more people have joined since then. So once again, if you have any symbols that you're curious about and want to walk through, please let me know and we'll add it to my list here. Otherwise, there were a couple of things that I did want to check out. And like I said, if I don't see anything pop up, I'm happy to pull up some scans and work through it that way. So let's start with DXCM first. So this one, well, I guess I should have done something on Friday on this or Thursday, but this one was actually on my short watch list for a potential bearish trade. And I can see that that's already started to kind of follow through off the 30-period simple. The reason why I liked this is we started to trend lower, right? We broke the 100-period simple. Our moving averages turned into a bearish trend. We hit some bearish exhaustion. So once again, kind of like we talked about with bullish exhaustion. And Jennifer, I see Apple, absolutely. We'll take a look at that right after this. Once we see some bearish exhaustion, we know that momentum needs to reset. And so we know that the price is either going to bounce up with the momentum bars or it's going to consolidate. And in this case, we got a little bit of both, right? We bounced a little bit higher into the 30 as resistance, and then we started to consolidate. And then from there, right, we also had a pullback signal on the compound breakout tool, letting us know that we would at least go up and test resistance. And then all of a sudden that started to cancel out. We started to get some red bars on momentum off of the 0 line. So usually when momentum resets and then it starts to roll back down like this, that's a nice bearish trend signal. And you can see we start to fail the 30. So really To me, Thursday would have been a good day to jump into this if I was watching it a little bit more closely that day, because we held the 30 as resistance and we started to break below the 10, which prior to that had been acting as support, right? You kind of see how we went into a wedge pattern here between the 10 and the 30. And then once we started to break, that's a good clue of how this could move down. Now, there was technically some price support around 100 that you wanted to be mindful of. So you might have given it an extra day. And if you did, I don't certainly blame you. But once we started to break below 100, you had confirmation that the bars were still kind of turning red. You certainly had the bearish signal today on the compound breakout tool. And then you had the Bollinger Bands flaring open. All of that's a good sign that this is getting ready to roll down into a new low. And so that's what we're seeing here. And once again, agreement on all the indicators. You have a squeeze that's still valid. So that means that there still could be some energy and strength to play this to the downside. I'm not necessarily a fan of opening a trade near the lower Bollinger Band. I prefer to do it off of the moving averages, in this case, acting as resistance. But let's take a quick look at the weekly chart. Weekly chart, a lot of room to continue lower on momentum. That's a good sign for the bears. And yeah, we can absolutely look at RUT. I'll add that to the list as well. We'll look at it right after Apple. Just to finish out DXCM though, so we still have plenty of room on weekly momentum for this to continue lower. Still a valid bearish signal. Here we have the weekly squeeze that started to fire to the downside that helped with the catalyst of breaking our 100 period simple and ATR trailing stop as support. You see the Bollinger Bands flaring open. Once again, though, it's not necessarily at a resistance level that makes it a clean entry to jump in at. Arguably, I guess if it bounced back up towards 100 and held that as resistance, that would at least act as a price resistance level for us to maybe jump in and then look at shorting to play lower. But if you are already in something, it's looking solid. Of course, there's nothing wrong with taking profits, but if you do have multiple contracts on, you may consider leaving one on as a runner, given that there's still a lot of room as well as a squeeze behind this move, possibly continuing lower. So let's take a look at Apple next. Jennifer, Apple's actually one of the ones that I've been watching. Pretty interesting moves today. So we'll certainly talk about that. And then afterwards, we'll of course go over RUT. And once again, guys, if you have any other symbols you want to look at, feel free to type them in the chat. And we'll try and get to all of them today. But starting with Apple here, overall, you can see that we have some price support around 175, and this will make a little bit more sense when we pull up the weekly chart here in a second. But from a daily perspective, you can see 175 has done a pretty good job of holding up. At the same time, though, whenever we tried to break and get this bounce higher, didn't quite fill the gap, unfortunately. That's what I was looking for, was a gap fill here. Didn't quite get it, got close, but didn't get all the way there. That's at 190.69 for that move to follow through on. And then it started to reverse back down. And part of the reason this reversed, if y'all recall, was because China came out and mentioned, hey, we're not going to let any sort of government employees. And I do see Microsoft, I'll add that to the list. But China basically came out and said, yeah, any government employees, you're not using iPhones anymore, right? And so, of course, China is a huge market for this now. They didn't ban it for everyone necessarily, but obviously, if you are in China, there might be a good chance that you work for the government there. And so that's going to cut into the market. And that's part of the reason we saw this stronger dip to the downside. There is also the case, too, that we had the Apple event last week. And as we had talked about in the small account mentorship, I know there is sometimes selling pressure going into the Apple event itself. And so we also had a double hit combo with that. That's why even though we went down, tested 175 and attempted to bounce, we weren't able to break the 100 period simple, which usually isn't a good sign for bulls. And then on the Apple event, we started to sell back off towards that range. The good news for bulls is we did a pretty good job of holding this level. Currently, the Bollinger Bands have flattened back out. We're getting a nice solid bounce up into resistance today. Still aren't above the 100 period simple. So that would make me a little bit cautious, right? Of, getting too heavy on the bullish side of things, especially because if the market does end up selling off, let's say from PAL, then we need to be very mindful that Apple, because it's such a big component of the market, could follow along with that. And yeah, I'd be happy to talk about how I use the Awesome Oscillator TG. Let me finish up the analysis on Apple, and then we'll go over it together when it comes through. But on the weekly chart here, and here's a great example. So part of the reason I use the Awesome Oscillator is to help identify exhaustion levels, right? So in this case, we had a beautiful run up. We hit bullish exhaustion. So that was a good sign that if you were long from the start of the year, you might want to go ahead and protect your profits at this point, because there's a good possibility that we could either start to stall or pull back. And in this case, the price pulled back into support, and you're seeing momentum's getting the reset that it's looking for. Now, once the momentum resets, if it starts to build back up, right, that's a clue to jump back in for a new long entry, right, when it's on the bullish side. Or if it gets across above or below the zero line, in this case it was below, that's a clue to say, hey, maybe I should take this short into the next support level, or potentially into a bearish trend move. And so those are just a couple of the ways that I use the Awesome Oscillator to help identify maybe when to take profits, or when the trend might be changing versus when it's picking up and starting to go. And of course, I love to pair that with the compound breakout tool, with squeezes or true low signals. All of those, when they're in agreement, can make for a pretty solid setup. So let's dive in here to what's happening currently with Apple. Right now, like I mentioned, Apple is at exhaustion. It's pulling back. You have some consolidation on the compound breakout tool. You have a squeeze forming. So all of that makes sense with the pullback and momentum. You can see here on the top chart, Bollinger Bands are flat. That matches that consolidation side of things. The moving averages, though, are still technically bullish. The 10 is still above the 30. Both are above the 100. So it has that weight to it. Same thing with the momentum bars. Even though they're technically pulling back, the fact that they're still above the zero line adds more bullish than bearish weight to it. Now, if the bars start to cross below the zero line, kind of like what they did back here, then you need to be mindful of it getting a little bit more selling to it, right, with the underlying price. But currently it's holding up well, so it's all in chop. And then when we zoom in here a bit more, you can see that 175 price level that we talked about on the daily chart. Well, it makes sense why it's holding, because it's right at technical support on a weekly time frame between the ATR trailing stop, which is at 174.28, and the 30 period simple, which is currently now at 175.74. So this is actually doing a really good job of holding weekly support while everything else is looking to reset, right? It just ran that marathon to the upside. It needed a water break. And so it's just pausing and refreshing itself before the next move occurs. Now, once again, if momentum starts to cross below the zero line, if we get selling off the Fed, right, or maybe some more news and catalyst comes out of China, that could cause for a break of support and continuation lower. It's never good that you're trading below the 100 period simple on a daily chart. However, if the flip side is true, if we don't get any sort of rate hike, if that's already priced in, if the market can maintain this bullish sentiment, this might actually be a pretty good buy-in level for a longer term swing trade to play Apple back to the upside. And so I might put a little, I already have a bullish trade on an Apple. I might consider adding a bit more to it depending on how this looks into the close for a very small risk. But I'm definitely not going to be loading the boat by any means before going into the Fed news Wednesday, right? There's no chance of that. And that's mainly because Apple, one, I want to be mindful, of course, of my account and the capital I put in before the Fed. But two, because Apple specifically is such a big component of the market, I know that even if the market, Apple has some good news that comes out for whatever reason, it still might not be able to keep up with the market, or at the very least, it might remain flat here. And if I'm being more directional, like with a long call, I need to be mindful of that being a possibility and how much time I give myself on the trade idea if I'm looking for a bounce. And of course, if I am bullish and it really starts to break this price level here, that would be a point that if there is any capital left on the trade, I'm cutting it to protect it, right? I want to protect the risk if the technicals on the chart change from what I'm wanting to see. So That's my 2 cents on Apple. Kind of in a tough spot, like I mentioned. If it starts to break back above the 100, then that's going to look really good for the bulls. But if it can't, if the weekly unfortunately starts to break that support level, then you might want to look for the reversal on the bears. And then AFRM, let me write that in, AFRM. We can take a look at that as well as PLTR, certainly. Yeah, Mike. Yeah, for those of you who don't know, our simpler website is running. It doesn't happen a lot, but for whatever reason, it's running into some tech issues today. So we decided to jump over here on YouTube and Twitch and on Facebook or anywhere else you might be joining us and doing our sessions live here for today. Now that we've gotten it all set up, so that way we don't miss a beat, right? Not necessarily the week you want to do that. Let's pull up RUT. And then we'll look at some of these others and let's check my time. Okay, I still got 20 minutes until the end of my session. After me, Mary Ellen will be on. Now, she won't necessarily be on my Twitch, but for those of you over at YouTube and stuff, she will be hopping in after me. So look forward to that. I always love hearing her analysis on sector rotation and everything like that. And certainly for those of you on Twitch, feel free to jump over then to YouTube if you want to check her out as well. But let's keep going here. So RUT is actually the weakest out of all three of the indexes. Unlike SPX and NDX, they're trying to hold a bit more of their bullish sentiment on the daily chart, and they're certainly well above their 100-period simple. RUT is actually trading below the 100, and our moving averages are definitely more in consolidation. The 10-period simple is just now crossing below the 100. The 30 is still above it, so we're not stacked up, we're not stacked down. But the fact that the underlying price is below all of our moving averages does add a little bit of that bearish weight. On top of that momentum, which right now is technically in the process of resetting, the bars themselves are below the zero line. So that adds to that bearish weight too. Our compound breakout signal is choppy, so that's more consolidation. We have a squeeze forming. And the choppiness makes sense because you can see here once again, we are right around some sort of price support level that we've been attempting to hold in the past. So let's take a look at the weekly chart real quick and see if we're at weekly support. And we are. We're right at the 30-period simple. So that's the level that's really been holding. You can see throughout the week, we might have dipped a little bit below that, but all the close and open of these last several weeks of these bars, really since August 14th, which is my birthday, shout out to that. You can see here, we've done a pretty good job of maintaining that level. So it could be another case of where we dip below this range midweek. But if we get any sort of bounce, right, could be a case of where we bounce back up and hold this range, or if the Fed news is positive, we could immediately bounce and continue to hold this as support. If that's the case, my next target from a weekly perspective, at least, would still only be up towards just a little shy of 1900, right? In that psychological level where the 10 and the 100-period simple are at. You can see there the last few times that we've tested that range, it's what's been holding as resistance. We're basically starting to go into a wedge pattern here, at least as of right now, where the 30 is attempting to hold support and the 110 are holding resistance. Now, outside of that, Bollinger Bands are flat. That's consolidation. Same with the compound breakout tool. We do have some true lows printing, which if the market could turn bullish, might give us that, stronger bounce and trend move to the upside here, for example. Whenever we're at the low end of the range from that last year into this year and that printed, you did have at least a run up to play into resistance. But my caution for everybody is, you can see when we zoom out here from a bigger picture point of view, this has really just been in a wide range of chop, arguably, with the top of that range being right around 2000 and the bottom of this range being right around 1700. We've had a few dips below that, so you might argue it's 1650-ish. But right at those levels, basically, that's been support. And you can see we're kind of in the middle of that range. On top of that, the second thing to be mindful of from being too bullish about this, at least as of yet, is the fact that we've been trending below the 100. So we did form a bearish trend below the 100-period simple, and we have not been able to get a strong break back above it. We attempted to break it back above it here, But when you can't get going, right, when it's not a nice, strong trend break to the upside, it's a very cautious sign to bulls that the bears might still be in control. And any sort of break of the 100 usually is a place to get short from, especially when you retest it like this and fail to break above the 100 again. That's usually a place to consider getting short, at least into your support levels in this case, if not for an overall trend move lower. So I would say RUT's the weakest out of all here, right? Because you're right at that weekly support and price support. I'd prefer at least a bounce back up into these moving averages. And if it fails, then, jumping back in the short side again. But if you did think that PAL, for example, was maybe going to make things sell, RUT, I would argue, is maybe a little bit more primed for that selling to occur on just from the technical chart pattern that's being presented to us right now. Let's go on to Microsoft. So Microsoft here kind of reminds me similar of Apple, but doing a bit better of a job holding up, right? It didn't have any of that China news that came out that weighed it down compared to Apple. But it too pulled back into its 100-period simple, attempted to hold it as support, tried for a break, but is kind of stalling out and failing at it. Having a hard time getting above 340 in this case. And now we've dropped back down into the 100. Now, if the 100-period simple can hold, once again, this could actually be a buy opportunity to jump back into Microsoft. And you might consider doing more of a credit spread, right? Work off the theta decay, or you could look at a directional trade. The downside to doing a theta decay style trade currently on Microsoft is, once again, we have the Fed news. So even though, usually that option premium, the way it's built in is built into the indexes themselves, the same thing can still apply to these bigger names like Microsoft. So if you put on, let's say, put credit spread for today, you might not really get that profit that you're anticipating until later in the week, or at least until after the Fed news Wednesday. So once again, be very mindful of the short-term risks that you hold on through that announcement, because if the market dislikes whatever Powell and the Feds are saying, right, or if we get the rate hike and that's not what's priced in currently to the market and they're not happy about it, this could easily start to break support and roll over. We certainly still have a valid pullback signal. So whenever this printed, this was a good clue that we were going to go down and test support. We're currently there. If it breaks and this remains valid, then we'll likely go down to the next support level of the ATR, which is around 320. If that breaks and this is still valid, then it turns into a bearish trend signal. Momentum attempted to cross above the zero lines. That had a little bit of that bullish strength there to get us up into 340. But as you can see today, we're already forming a red bar. So I wouldn't be too surprised if it kind of hangs out around the zero line and chops, right? Once again, going into Wednesday, that wouldn't be too surprising whatsoever. From a weekly perspective, on the weekly chart, for those of you who had the true low indicator and bought in here, well done, right? Beautiful bounce to the upside. We went right into the ATR trailing stop that held, basically is holding right around price resistance. And currently we're consolidating. We've had back-to-back divergent bars, which so far they've all followed through, but back-to-back divergent bars can be a sign of chop. Momentum is overall bullish, room to move higher. Technically still a valid bullish signal as of right now in the compound breakout tool, and that's because the trend has also turned bullish with our moving averages. And it looks like our weekly squeeze is attempting to fire here, but of course you can see pretty clearly this overhead resistance to be aware of. 350 as a psychological level, and then the ATR trailing stop being at 350 higher, so it applies to monthly too. Usually you get a stronger bullish trend signal. So you can see if you bought back there in 2012 when it was way down here at what, like 30.50, right? Great place to buy in shares for that bigger run to the upside. So if we can manage to break the ATR trailing stop, could be a good place to buy in longer term for a move higher. But nothing. See, let me pull up the weekly. There's the weekly. Austin, that's in the process of resetting. You're starting to get a consolidating signal on the compound breakout tool. You're building into a squeeze. Here, the bullish trend is doing a good job of holding up, but very much like Apple, it's just hanging out right now. So overall, might not be a bad spot to consider buying in. You know of that monthly resistance above you want to be aware of. But you don't have any buy signals yet that are really telling me to pull the trigger on this, which means we might just stay in chop for a bit longer. So no trade idea I'd necessarily want to take other than maybe a short-term one. But once again, the caution of the short-term trade idea is the premium around that going into the Fed news this week. So after Microsoft here is AFRM. Let's pull that up. So on AFRM, this has had a great bullish run to the upside. There were those true low signals right before earnings, and even after earnings, they remained valid. That would have been a good place to buy in for the current run. You also had the bullish signal on the compound breakout tool. Momentum crossed above the zero line. So you had all this agreement between bullish sentiment and indicators. Certainly, you might have been a little cautious of price resistance right around $19, $20. But once we broke that, that was another clue to stay the course to the upside. On Friday, you got a bullish divergent bar. So notice that followed through with the higher high today. Well done for those of you who took that signal and caught it. As of right now, for me, there's nothing to do on this. Now, if you have multiple contracts, once again, there's no harm in taking profits, but feel free to keep this out there and keep a runner on, because there's nothing yet telling you to get out of the trade. It's doing a good job of holding the 10. You still have your Bollinger Bands opening up, and all of this still remains bullish on our lower indicators. The one caution I would have, though, is once again, we're at the top of the axis. And the last time that we were at this level, you did get a sign of exhaustion and started to see a pullback. So just, be mindful of that. If you start to see a couple red bars in a row, that could be a clue that the price is going to start to stall or pull back, and you'll want to take the remainder of those profits. So for me personally, this isn't a place to buy in at, right? This is a case of FOMO if I'm looking to buy in here, because the move has basically already happened and momentum is right at the top of the axis. Now, unless it starts to really adjust the axis higher, this isn't, a good place to jump in. And even if I'm looking for the quick overnight move, I'd prefer to do that off of support with something like a bullish divergent bar, right? Where I know there's that probability of a higher high within 3 bars. And so I can take the quick scalp and the long that way. Otherwise, at this point, I probably need to wait for it to reset again before trying to get long. From a weekly perspective, there's a lot of room on momentum. So if you have it like as really a long-term leap, or that's what you're preferring to open here, then, arguably, I guess you could jump into it. I still think you could probably time the entry better off the daily. But that being said, the target to the upside would be the 100-period simple, which is currently at 33.47, right? 33, the magic number. So that's AFRM. And then PLTR, let me do that. Make sure I'm still good on time. Perfect. So on PLTR, from a daily perspective, here's another great example of where you're at exhaustion. Price went up, arguably, I guess, a little bit higher, kind of started to chop and then pulled back, consolidated. That allowed momentum to reset and then gave you another chance to maybe go long for the next run higher. Currently, however, we had a bit stronger of a pullback, went down towards the 100-period simple, hasn't broken that. So that's a good sign for bulls. You did get a little bit of bearish exhaustion here. You can see the green bars are currently resetting. So once again, when momentum resets, it's either a sign that the price will go in that direction, in this case for a bounce, or it will consolidate. And so you can see we moved, I guess, arguably a little bit higher, but we've basically been chopping. That matches with the compound breakout tool consolidating, matches with our moving averages being converged. Our Bollinger Bands are flat. We have a squeeze building up, but you did have a recent true low, which to me is interesting, right? Those true lows can sometimes lead to those longer trend signals. So the fact that we haven't broken below the 100, we had that recently. We have a squeeze building up. Certainly, if we can get a little bit more bullish sentiment, like momentum crossing above the zero line or a bullish signal in the compound breakout tool, that could certainly help us out. We are attempting a bullish divergent bar today. Now, once again, you'll still want to wait closer into the close to make sure that remains a valid signal. But if it does, that could arguably be a buy-in entry. The caution, of course, is once again, you have some price resistance here right around 1620. And so it might just be a quick follow through of a higher high, and then it still just chops in this range. If it can get going into a bit more of a trend move, then my next target would be 1747, which is right at the ATR trailing stop. Really quickly on the weekly chart actually has some recent true lows. So that's in line with that. Momentum's still in the process of resetting, though. This is still a consolidating signal. I like that it's in a bullish trend. And this here shows a little bit more strength. So notice how this was trending below the 100. It bounced up. On the pullback, it held the 100 and then bounced higher. That's a better sign for bulls that this is at least attempting to maintain that support rather than falling down. And NG, yeah, if we have time, absolutely, I'll be happy to talk about Disney. But you can see here overall, it's stalling, right, with that consolidation and reset of momentum. So we have the back-to-back divergent bars. Technically, all of these have followed through, either with, in case of the bearish divergent bars, a lower low or a higher high. But you can see that overall it's remained flat. The Bollinger Bands are coming together. Obviously, it's a Monday, so it's trying to make a bullish divergent bar here, but that could change by Friday of this week. But, I'd say arguably if the 100 period simple maintains holding overall, might not be a bad place to buy in for a longer term swing. And then last, but probably certainly not least, let's look at Disney. So Disney is in a bearish trend right now. We broke our 100 period simple and our moving averages are now stacked down for a move lower. Here's a great example of where it bounced up, tested the 100, failed to break above it. So it was a place for shorts to buy back in on, right, with puts and play it to the downside. Currently, we went down, tested a new low around 80, and are in the process of bouncing back up again into resistance. That's allowing momentum to get another reset to the zero line. You have a bullish pullback signal. So when you're in a bearish trend and you get a bullish signal in the compound breakout tool, once again, that's a clue that first it's telling you that we'll go up and test resistance. And then if we break a resistance level and it remains valid, you go up to test the next one, right? And so we went up, tested the 10, we broke that. We tested the 30 and ATR trailing stop. We've started to break that. And this hasn't canceled out yet. So arguably, we could get maybe a little bit more of a run up to test the 100 period simple. The thing that has me cautious about it moving much further, though, is one, you can see that this $86 price level has kind of been price resistance, right? It acted that way back here, and now it's acting that way the last 2 weeks, as of at least as of right now. Once again, it's a Monday this week, so that could change. But two, also the Bollinger Bands are flat. So they're not opening up, at least as of yet, anticipating that move higher. They're anticipating right now that we're not going to move higher and it's going to stay within this range. So just be mindful that could cancel out and lead us back into chop. I don't know if there's a trade necessarily I'd really want to take on it at this time. I don't have any bearish pullback signals printing just yet that tells me it's going to roll over, right? And so I wouldn't want to put capital into a bearish trade and then have this just remain choppy and hanging out, or still trying to bounce up to test the 100. But I will say if it does go up to test the 100 and it fails to break above it like it did here, I would look to short with a call credit spread or maybe a bit more of a directional trade to play for a rollover move. If it does bounce up to test the 100 and starts to break, then obviously that would cancel out the bearish trade idea and we could relook at this later. And yeah, CMR, if I were to take any trades, I would post it in chat and let you know, but I have not taken anything during my session here today. I didn't see anything that really screamed to me, this is absolutely a buy-in spot. And the only one I'd maybe considered doing something on was that SPX trade I mentioned earlier, right? Maybe playing for some sort of bullish move back into 4,500, but that's only if the bullish divergent bar prints. And that, unfortunately, I'm going to have to wait on closer into the close of market to see whether or not that occurs. So that is basically my time, guys. Now, once again, thank you guys for joining me overall. For anyone over on my Twitch channel, the stream will stop here. And in general, it will technically, I guess, stop for everybody. But for those of you that are on the simpler trading sites, either over on YouTube or Facebook, Feel free to stick around. Mary Ellen will be up right after me. And certainly for those of you on Twitch, feel free to hop over to our Simpler Trading YouTube channel, and you can keep up with the next Simpler Trader and go over, more than likely, sector rotation and some of the stuff that Mary Ellen's looking at for the market this week. As always, may the trade be with you, my fellow Jedis, and I look forward to talking to y'all next time. Bye, guys.